Welcome to this week's edition of Macro and Flows from Orestes Capital for the week ending on August 21st, 2026. We're Elena and Marcus.
Thank you. It's good to be here to break all this down.
Yeah, and we have a very significant contradiction in the global markets to examine in this deep dive because, the underlying mathematics of our economic models indicate that we are in a state of absolute structural euphoria.
Yes.
But at the same time, institutional investors are trading as though a systemic collapse is imminent. So our objective today is to really bridge that gap.
Exactly. I mean, to accurately assess this environment, we must maintain a very strict boundary between the structural foundation of the economy and the immediate tactical surface of the market.
Right.
Because the structural foundation remains highly robust. The tactical surface, however, is, it's severely exhausted.
And that distinction really is the anchor for our entire discussion this week. To understand the structural foundation, we need to look at the internal view, specifically the OCM-PCA model.
Yes, the PCA model is critical here.
And for our listeners reviewing the latest outputs, PCA stands for Principal Component Analysis. Now, the mathematics behind it are quite complex,
but the real-world application is actually straightforward.
Exactly. You can think of it sort of like an advanced diagnostic tool that you might, plug into a vehicle's onboard computer.
That's a great analogy.
Yeah.
It acts as a noise-canceling filter.
Yeah, because the daily headlines, the intraday volatility, isolated geopolitical events, that is all just noise on the dashboard.
Right. And the PCA model mathematically strips away that daily static. It ingests thousands of cross-asset variables.
Right.
So we're talking sovereign yields, credit spreads, global commodity prices.
Everything.
Everything. And it isolates the primary underlying pistons that are actually driving asset prices over a multi-year horizon. It finds the actual signal within all that noise.
And when we isolate that specific signal this week, the OCM-PCA model places the macro environment firmly in a structural reflation regime.
It does.
The underlying growth state isn't just stable, it has actually breached the upper statistical threshold into what our proprietary modeling categorizes as euphoria.
Which is significant.
Very. The data places us in the 94.7th percentile, registering a z-score of positive 1.35.
And just to contextualize that positive 1.35 z-score for a standard portfolio, it essentially means the current economic growth metrics are operating more than one full standard deviation above their historical average.
Right. It's a massive deviation.
Yes. When you filter out the friction, the underlying economic momentum is genuinely firing on all cylinders.
Yep.
I mean, this is a statistically significant multi-year expansionary trend.
But this is where the external view presents a profound disconnect, because the prevailing narrative across the street is heavily fixated on what market intelligence refers to as an unstable mix.
They are.
The consensus across the street is pricing in softening global growth, persistent duration risk, and the lingering effects of restrictive central bank rates.
Well, the consensus across the street is basically reacting to the immediate tactical friction. The OCM factor trends, conversely, are anchoring to that structural current we just mentioned.
Which requires some immediate pushback on the data, if I'm being honest, because if our proprietary modeling indicates that we are in a state of structural euphoria, why does the market feel so fragile this week?
That's the key question.
I mean, why are we seeing aggressive, violent sell-offs and sudden spikes in volatility if the underlying growth is really this strong?
The fragility is entirely a function of tactical overextension.
Okay.
While the long-term structural trend is highly positive, the short-term pro-growth momentum has been running excessively hot for 4 consecutive weeks now.
Yeah.
In fact, our model registered a 100% positive sign ratio over that specific period.
Which is unsustainable.
Exactly. When an engine runs at maximum capacity without a cooling cycle, it becomes structurally vulnerable to a mean reversion snapback.
Mm-hmm.
The market's foundation is sound, but tactically, the rubber band has been stretched to its absolute limit. In this state, any marginal data disappointment triggers an immediate mechanical de-risking event.
That concept of tactical vulnerability leads us directly into a structural analysis of investor positioning. Because to understand the mechanics of this mean reversion, we really have to examine who is currently providing liquidity to the market.
And who is actively pulling it away.
Precisely.
And the data there reveals a severe fracture in positioning, specifically between systematic traders and everyday retail investors.
Let us demystify systematic traders for a moment, as they are driving a significant portion of this volatility. When we discuss commodity trading advisors or systematic trend followers, we are not talking about traditional portfolio managers analyzing balance sheets, right?
No, not at all. These are purely algorithmic systems.
They are computers programmed to operate entirely on price momentum. If a trend accelerates upward, the algorithm piles into the passenger seat and buys. If the trend stalls or reverses, the algorithm aggressively liquidates. They are mathematically agnostic to underlying company fundamentals.
Completely agnostic. And currently, market intelligence shows that systematic equity positioning remains overweight. It's sitting at the 77th percentile.
Yeah.
However, the most violent algorithmic execution over the past 3 weeks did not occur in the equity markets. It actually occurred in commodities.
The gold trade.
Yes. Systematic trend followers executed a massive V-shaped reversal in gold, generating a record $22.2 billion in speculative buying.
And just to clarify the mechanics there, these algorithms utilize specific look-back windows. They're often measuring the 3-month or 6-month moving average of an asset's price.
Oh, right.
So when the price of gold crossed above that mathematical threshold, it triggered an absolute unemotional buy signal across dozens of funds simultaneously.
Yeah, they flipped from being deeply net short to heavily net long in a matter of days.
Yeah.
The machines just executed relentlessly.
But while the systematic algorithms were mathematically forced to chase safe haven assets like gold, we observed a very stark contrarian reaction in retail flows.
We did. And the divergence here is critical for understanding the current market structure.
Because institutional hedge funds have been aggressively de-risking. They are reducing gross exposure, unwinding leverage, and net selling North Asian and U.S. technology stocks.
Yes, they're pulling back.
But retail investors have stepped in to act as a massive shock absorber. They are essentially taking the other side of the institutional trade.
Which is fascinating. We saw retail traders pour $2.5 billion into Kospi equities in a single week.
That's incredible.
Furthermore, they aggressively bought the dip in U.S. mega-cap technology and semiconductors, stepping directly in front of all that institutional supply.
Which raises an essential question about market direction. I mean, if the quantitative funds are mathematically forced to bid up gold and institutional hedge funds are liquidating technology stocks, but retail investors are absorbing that exact tech supply.
Who's actually driving the bus right now?
Yeah, exactly. Who is dictating the direction?
The reality is that no single cohort is in control. We're observing a fractured market where traditional directional momentum has just broken down.
Right.
When institutional funds reduce exposure and retail capital absorbs the supply, the market loses its consensus. It becomes range-bound, choppy, and highly reactive to microcatalysts.
And that fracturing of momentum does not occur in a vacuum. It is directly tied to a severe geographic divergence in the global macroeconomic data and, of course, shifting central bank policy.
Let us begin with the deflationary pressures emanating from China, because the July activity data revealed broad and severe decelerations.
Yeah, it was a tough print.
Very. Industrial production missed expectations, coming in at 4.5%, and retail sales grew at a mere 0.7%.
The implication of a 0.7% retail sales figure in a 1.4 billion person economy is profound.
It really is.
I mean, it indicates a near total collapse in domestic consumer demand. And mechanically, when a manufacturing powerhouse of that scale experiences collapsing domestic consumption, they must export their excess capacity.
Absolutely.
If their own citizens are not purchasing the goods they produce, they will flood global markets at discounted prices, effectively exporting a deflationary drag to the rest of the world.
Meanwhile, the dynamics in the United States present a completely opposing set of structural pressures.
Very different picture.
Yeah, we saw the 30-year Treasury yield surge to a multi-decade high this week, touching 5.33% before eventually settling at 5.25%.
And it is so important to understand that this yield expansion was not driven by robust economic growth expectations.
No.
It was driven by term premium repricing. Investors are demanding a higher yield premium to compensate for the risk of holding long-duration sovereign debt.
Yeah.
Largely because they are anticipating a massive schedule of corporate debt issuance, particularly from technology firms funding artificial intelligence infrastructure.
And the policy response to this rising yield environment was immediate, though it ultimately proved ineffective. The U.S. Treasury doubled its buyback operations to $4 billion in a targeted attempt to provide liquidity to the long end of the sovereign curve.
Mechanically, a Treasury buyback is designed to sort of grease the wheels of the bond market.
Right.
By purchasing off-the-run, less liquid bonds from primary dealers, the Treasury frees up balance sheet capacity for those dealers to absorb new debt issuance, which should theoretically stabilize or lower yields.
Theoretically, yes.
But it provided only a fleeting one-day rally. The yields quickly retraced and just continued their upward trajectory.
Which brings us to central bank signaling ahead of Jackson Hole. We often compare shifting central bank policy to steering a supertanker.
Right, you cannot simply rip the steering wheel at 40 knots without structurally breaking the vessel apart.
Exactly. Small, telegraphed adjustments at the helm are required because even a quarter-point shift in the policy rate ripples massively into everyday liquidity and credit conditions for regular investors.
Yeah, the market hangs on every word because the trajectory matters more than the immediate speed.
But we really must evaluate the failure of the Treasury's intervention here.
Yeah, I wanted to push back on that $4 billion figure.
Go ahead.
If a targeted $4 billion liquidity injection could not halt the rise in the 30-year yield, what does that actually signal? To me, it signals that the mechanical plumbing of the sovereign debt market is groaning under the sheer weight of structural supply.
I agree completely. The overarching fiscal deficit is simply too large for standard dealer capacity to absorb without demanding higher yields.
And that sovereign rate pressure inevitably bleeds directly into the mechanical plumbing of the stock market. Because to fully understand the violent equity volatility we experienced this week, we have to look past the macro headlines and examine the options expiration, or OPEX, dynamics.
Yes, and this requires a clear understanding of dealer gamma.
And we can demystify dealer gamma without relying on complex black soulless mathematics. Think of Wall Street options dealers primarily as middlemen managing their risk books.
Right. Their mandate is not to bet on the directional movement of the S&P 500.
No. Their mandate is to facilitate trades for clients and keep their own risk books perfectly neutral.
Exactly.
In standard market conditions, these dealers act as shock absorbers. If the broader market falls, their mathematical exposure requires them to step in and buy futures to hedge their books. If the market rises, they're required to sell.
Yeah.
So their daily hedging activity actively dampens market volatility.
However, when the market transitions into a short gamma regime, that entire mathematical dynamic inverts. The dealers transition from being shock absorbers to becoming amplifiers.
Because of the way their options exposure shifts as underlying prices move.
Correct. They are mathematically forced to sell into a declining market, which mechanically accelerates the drop, and they are forced to buy into a rising market, which accelerates the rally.
So they basically amplify the exact direction the market is already moving, creating these violent swings.
Yes. The S&P 500 price action this week was a textbook demonstration of this short gamma plumbing in action. The index was mechanically trapped in a highly defined band. We observed a firm floor at 7640 and a structural ceiling at 7700.
The index rallied to the upper edge near 7,700, faced immediate mechanical rejection from the dealers, and
faded directly back.
Yeah, faded directly back into the middle of the band, ultimately closing the week at 7674.37.
Which is pinned almost exactly to the OPEX max pain level of 7665.
And for context, max pain is the specific price point where the maximum number of options contracts expire worthless.
Yes.
This causes the maximum financial pain to the retail and institutional buyers of those auctions and maximizes the retained profit for the dealers who sold them.
This can sound highly theoretical, I know, but it has a direct impact on a regular investor managing a standard portfolio.
How so?
Well, when the market is trapped in a short gamma band, it creates choppy, violent intraday price swings that ultimately resolve absolutely nowhere. An investor watching the screen might see the S&P 500 plunge 50 points in panic, assuming a structural breakdown is underway. Or they might see it rip higher and deploy capital, assuming a new breakout has begun.
But it is neither.
Exactly. It is just the machines hedging their options exposure. Investors must not mistake mechanical daily noise for a fundamental signal.
And synthesizing these elements, the short gamma trap, the shifting term premium in yields, and the stretched OCM-PCA growth signals allows us to identify the pain trade.
Yes, the pain trade.
This is the specific market scenario where the consensus across the street is most likely to be caught off guard and forced to violently adjust their portfolios.
And to identify the current pain trade, we have to look at the severe underlying dispersion that the prevailing narrative is largely ignoring.
Because the financial media is heavily focused on the stability of the index level, but beneath the surface, the structural rotations are extremely violent.
Just look at the momentum factor.
Yeah, that's a perfect example.
The momentum factor has suffered over 20 single-day crashes. greater than 5% so far in 2026.
And to put that in context, that surpasses the total number of crashes over the previous 5 years combined.
It's staggering.
A 5% single-day factor crash is not standard volatility. It is a systemic liquidation event for a quantitative fund operating on leverage.
Yeah.
Experiencing 20 of these events in 8 months indicates extreme structural fragility in the consensus momentum trade.
We are observing equally severe dispersion in the credit markets, actually. This week, high-grade AI hyperscaler bound spreads widened by nearly 7 basis points.
Wow. That's a significant move.
It is. The market is demanding a higher premium because these top-tier technology firms are simply bringing too much debt paper to the market to fund infrastructure buildouts.
But simultaneously, lower quality, high-yield data center debt actually tightened. We are seeing investors indiscriminately reach for yield in BB and CCC rated infrastructure debt. While they are demanding concessions from the fundamental high-grade hyperscalers, this spread decompression represents a highly unstable risk dynamic.
It does. And given this complex setup, the OCM-PCA model implies 3 clear, actionable directives for standard portfolios this week.
Let's go through them.
First, investors should favor real economy, cyclicals, copper, and energy. These assets offer natural convexity, meaning they have disproportionate upside potential in an active reflation regime.
Second, investors should maintain a structural underweight to core duration.
Correct.
The upward pressure on the 10-year and 30-year yields remains persistent due to that term premium repricing we discussed earlier.
And finally, investors should exploit the recent positive surge in the OCM-PCA Economic Surprise Index.
Yeah.
The Economic Surprise Index hit a Z-score of positive 1.12 this week. This means that the actual macroeconomic data being released is coming in significantly better than the street's downgraded pessimistic expectations.
And because the consensus across the street is currently fearful of a slowdown, downside portfolio hedges, specifically put options, have become relatively cheap to purchase.
Yes, they have.
So regular investors can use this temporary surge in positive economic surprises to buy those cheap hedges, guarding their portfolios against the tactical mean reversion and mechanical de-risking we outlined at the beginning of the show.
You want to buy fire insurance when the weather is clear and premiums are low, not when the house next door is actively burning.
That structural reality leaves us with a deeply provocative dynamic to monitor closely in the coming days. We noted earlier that retail investors have stepped in with billions of dollars to catch the falling knives in technology and semiconductors. They are acting as the primary liquidity providers, absorbing the massive institutional selling pressure. And that is the exact tension that could define the next quarter. If retail investors are currently the primary bid preventing a broader collapse in the tech sector, what happens to the underlying market structure if that retail liquidity exhausts itself before the systematic algorithms and institutional hedge funds finish unwinding their momentum trades?
See you next week, wherever the flows take us.